Welcome back to the Dividend Diplomats YouTube channel. You've got your boy Bert over here, and you know you're rolling with Lanny, the Dividend Diplomats, and we can't wait to talk to you about two potential dividend stocks to buy or these two dividend dogs to avoid.
Before we get into it though, smash that subscribe button. Give us that thumbs up, everybody. So freaking close to 10K. We're amped up. We're talking about the video. We're planning it out. So help us get there, please. Once and for all, let's end this. Get to 10,000. But now, we've been covering some stocks to buy recently on our channel. We've been going through some analyses. Laney and I are always looking for dividend stocks to buy to see what can we add to our portfolios. Laney found some dogs. Let's talk through them.
We found some dogs, but I always have to say, dogs gotta eat at some point, right, Bert?
Exactly, and they do. I mean, when you see the names that we're talking about, you're going to see how they've been around. They're in industries that are key components of our daily lives, whether it's on the consumer end, on the front end, or an industry that fuels everything else, which is why we are excited that maybe today they're dogs, but tomorrow they could be, what is the phrase here? They could be studs tomorrow. That's what I'm looking for. They could be
studs. They could be those Rottweilers ready to keep barking. So here we are. We're recording this video. It's August 7th. We're here talking about two dividend stocks, and maybe this is a time to buy them based on how they're performing year to date, but also how the stock market has performed relative to how these stocks have performed. So Bert, what's the S&P 500 currently trading at, by the way?
It continues to close and end at record highs. It ended over 4,400 at 4,436, I believe, Lanny.
Wow. So year to date, the stock market is up a whopping 20%. And in the past 52 weeks, the stock market, the S&P 500, is up over 32%. Well, these two stocks are both down over the last week, as well as are underperforming the S&P 500 on a 52-week basis, which is why we wanted to bring them to light and see if there's a room for these two stocks in your portfolio. Bert, go ahead. Let me hear about what you're about to say.
I was just about to say too, remember, we are dividend growth investors, but we also look for values, which is why we're always going to keep looking for these dogs. The first metric of our stock screener, in fact, is that valuation metric. We want to see that they are trading below the market. So that's why we are always so excited, and that's why we do like always paying attention to the dogs of the dial, the dogs of the dividend stocks, because we want to find that value that one day will increase.
We're trying to beat Warren Buffett to the punch here. He may or may not own one of these companies. But we will have to dive in to see what this is all about. But as Bert was saying, we use the Dividend Diplomat stock screener. The first metric is the price to earnings ratio. Second metric is that dividend payout ratio, the safety of the dividend. Third, dividend growth. Obviously, you want your income to grow going forward. And we always throw in that bonus metric, the dividend yield. So Bert, Mr. Oscar Mayer, baloney loving, what is our first stock here we're talking about?
Kraft-Heinz, ticker symbol KHC. This is one of the hot button, controversial stocks in the dividend investing community.
Like it's one of the sin stocks almost.
Not sin stock, but it could be a sin dividend stock based on what some people think about this company. Going through the journey here of Kraft-Heinz, they were separate, obviously. What was it? I can't remember the year they merged. Let's just say it was 5-6 years ago for the sake of it. They had your Kraft.
3G Capital came in and said, let's bring these guys together.
Yeah, we're going to use our experienced management team. We're going to cut costs. We're going to have all these synergies together.
We're going to put Heinz ketchup on Oscar Mayer bologna. We're going to put Philadelphia cream cheese, and we're going to mix it up with mustard.
Yeah, and everything sounded fantastic on paper, and the stock price rose. The dividend rose for a long time. But what else rose with this transaction, Lanny?
A lot of debt.
That was the key, and that was ultimately the killer here because his sales stalled. His performance stalled for the newly merged entity. Things weren't growing the way they wanted it to, despite they have this brand portfolio that has, I think it's like 10 plus.
Name some brands.
That has Kraft-Heinz, Oscar Mayer, Orleda, Kraft Mac and Cheese, Classico, Velveeta, Jello, Philadelphia. I mean, these are
all your breakfast treats right there.
Yeah, Kool-Aid,
Just
Lunchables.
sucking down that Kool-Aid.
Maxwell House too. Let's not forget because we always talk about Folgers.
My mom. Shout out to you on the Maxwell House coffee every single time.
They do have some good coffee, but the synergies and everything was just not the way it envisioned. A lot of debt, and eventually they had to make a very difficult choice there to cut that dividend. So
back in, I would say it was around, I don't know, 4 or 5 years ago, or 3 or 4 years ago, they had to cut that dividend down tremendously to help with their cash flow because of how much debt they had They wanted to improve their cash flow to help pay down the debt first in order to help, take care of the business. You have to take care of the business.
And if you look in the earnings release and you start seeing that, I believe it is long-term debt is down $4.5 billion, and that was what was reported. So it's moving in the right direction there.
Long-term debt is significantly down heading into, June 30th of 2021. So Kraft right now, again, is trading at $37.20 as of August 6th. Now, they currently, the analysts are expecting $2.66. So kraft-heinz right now has a price-to-earnings ratio of less than 14 times forward earnings.
Perfect. The market, while earlier in the year it was around 45 or higher, it's come down as earnings have gone up. And the overall market's earnings expectations are higher. It's now in the mid-30s, I believe, for the S&P 500's forward P ratio. This 14x for KHC is still significantly below that mark.
Little sign of undervaluation, especially in the consumer goods industry. Now, when we talk about that second dividend stock metric that the diplomats use, again, this is where, you kind of toast that Oscar Mayer a little bit. You want that toasted bologna sandwich because you want to look at the safety of their current dividend. Bert, what is that dividend payout ratio?
It is right at 60%, right on the money of the metric we use. So looks like they right-sized that dividend right into the spot that we want to see. Clearly, Kraft did it for us, right?
That's a heck of a payout ratio right now for them, and probably makes your Lunchable pizza taste a little bit better.
Yeah. Now, obviously, the third metric with the dividend growth.
Did you have the Lunchable pizzas?
Of course, I had a Lunchable pizza.
Man. That last little pizza that you made with the pepperoni always made me a little sad.
Yeah, I know. Once you knew it was ending, but you always saved the best for last, and you always loaded up that final one.
Oh, for sure. You saved a little bit extra for that last one.
Absolutely. And that third metric, that dividend growth, we talked about it. They cut their dividend. They haven't increased it yet. Judging by the payout ratio, earnings, sales, I'm not foreseeing a dividend increase in the next year or so, maybe with more debt paid down. Yeah, I could see it in the future, just not right now. I'd rather see them focus on the balance sheet.
So no dividend growth for that third stock metric for Kraft. But however, they're only up about 8.5% year to date in their stock price. And in the past 52 weeks, while the market is up over 30+%, Kraft is only up 5%.
Yeah, and they have a nice yield too. Their yield is 4.3% in here too. So at least you're getting paid a nice dividend while you're waiting for the growth to return.
Could you argue that having Kraft stock could be better than having your money in a savings account?
It could be.
You could argue it.
You could make that argument. That's a lot of the argument a lot of people made for AT&T over the years too.
So in summary, for kraft-heinz, ticker symbol KHC, price to earnings ratio under 14 times, payout ratio that is at the top end of the perfect payout ratio at 60%. Sadly, no dividend growth, but a dividend yield that is well above the S&P 500 on average, pretty much 3 times what it's currently yielding at 4.3%.
Fantastic. Maybe it's time to put them on my watch list right now. I'm interested.
Maybe it's time for Bert the Hurt to talk about this oil moving, this pipeline shaking, this ground moving pipeline company.
Another hotbed company in the dividend investing community. This is another controversial one because they also in the past had a dividend cut at the end of 2015 and the beginning of 2016, owned by the famous Richard Kinder, whose name is in the namesake of the company. You have Kinder Morgan, ticker symbol KMI.
KMI. So Bert and I, we got caught up. Again, this is from a dividend lesson for everybody else. We got caught up in the, oh wow, the yield is great, and they just continually to grow their dividend by any means necessary. And by any means, we mean taking on more of what?
Debt seems to be the story here with these companies that cut their dividend.
Debt was a great lesson we learned, and that's something that we obviously watch out for. And you've probably seen us introduce that more and more in our videos, because we realized how strong of a component it is, especially coming out of a pandemic.
For sure. And that's why we keep focusing on seeing a lot of these companies that may not grow their dividend. They may trim it down a little bit, but it's always with the intent of reducing their debt and improving their balance sheet.
I could not agree more. So Kinder Morgan, again, what once was a beloved dividend growth, oil-based, pipeline company stock, cut that dividend as well.
And they have a different dividend history, though, from Kraft-Heinz, because it was different. Once they right-sized that balance sheet, it took them a few years after it was slashed at the beginning of 2016. However, they started increasing again.
It came back, baby.
But it also was with a lot more caveats when you peeled back the earnings release that We're going to make sure we're doing it the right way. We're not going to stick to this if forecasts change, which is something we'll talk about when we get into the third metric. So I feel a lot better about Kinder Morgan's growth going forward.
So Kinder Morgan, in short, based on their last earnings release of the end of June of 2021, revenue is up right now, obviously year to date versus 2020 by a tune of 47%. Net income is also up significantly from $651 million net income versus a net loss of $943 million. Therefore, obviously, adjusted earnings per share is well above where they were last year, pretty much 2x at 83 cents versus 40 cents. So KMI is really doing better, as well as the entire oil industry. Obviously, the per barrel helps that, and that people are actually producing, moving, driving, you name it, again.
Yep, so let's jump into the metrics here. At the time of the video, $17.12 was their stock price. Forward earnings are $1.20, a P/E ratio, another company that's right around 14.
Not bad, Bert, not bad. Now, the dividend is a little bit interesting. Typically, with this company, you always look at operating cash flow, but we'll still just look at the payout ratio from the nuts and bolts of it. Not even looking at adjusted earnings. We're literally looking at what the analysts expect on an earnings per share unadjusted. So the payout ratio is looking at 90%, Bert.
And what will be interesting, though, is I wonder, since we grabbed the average analyst estimates from Yahoo, I wonder how much of that has baked in a higher oil price, because we have seen the price per barrel of oil jump up over the last few months, and we're starting to see how it factors in. Obviously, you would expect the analysts to change it, but just how much of that's baked into the Yahoo forecast, I think that'll be interesting to see, because if obviously earnings per share gets adjusted upwards by the analysts, you could see that payout ratio drop significantly.
Right. I mean, oil's right around $70 per barrel, which is obviously significantly higher than where it was, this time last year. So we'll have to see. Now, Bert, they cut their dividend back in late 15, early 16. Talk to me about that third metric, that dividend growth rate.
So what I think was interesting, and this is what was big for me to see from Kinder Morgan, when they started increasing their dividend, they got the balance sheet better. They announced with fanfare a 10%. It was about like 10%. We're going to increase our dividend. We want the dividend to be back. We want to do it the right way. We're going to shoot for 10% dividend growth. That's fantastic. That's also kind of what got the company into trouble in the last time, because they committed to this 10% and they did not budge from it. What's so critical to me now with this third year of dividend growth was their recent dividend announcement increase. They slowed it down. They didn't announce 10% dividend growth. When the market conditions changed, they were able to take a step back and say, we want to increase our dividend, but it's not responsible to increase it to 10%, so we're only going to announce a 3% increase. So to me, that's a huge sign for the company.
Huge sign. They're playing it smarter, playing it safer. Again, as Bert just said, they're now back on 3+ years of consistently increasing the dividend at an average dividend growth rate of 8.55%, which is pretty
very
stable,
solid,
pretty steady. Doing it in good years and slowing it down in lower performing years. I would expect a pretty strong one going into 2022, actually. Now, how are they performing from a stock price standpoint, by the way?
So year to date, they're up 26%.
Pretty good.
Their 52-week is only 19%, so they're making up some room there. And this last week, they dropped almost 2%.
So with that drop at 2%, and with them paying a dividend of $1.08 spread over the course of 4 quarters, what is that dividend yield as the bonus metric?
6.3%.
Wow. So higher than Kraft with a dividend growth rate?
Yeah. But for me personally, with my portfolio, I have a lot of oil, so I'm good for now.
Oil runs through the kids' veins.
Yeah, I need to start diversifying away from oil, but I can see why somebody who doesn't have the same exposure as I do would be very interested in potentially adding this dog.
So in summary, KMI has a PE ratio of also slightly over 14, a payout ratio that's on the very high end, under 100%, and it's at 90%. A dividend growth rate of 8.55% going on 3+ years with a strong yield of 6.3%. So Bert, are these two dogs staying dogs, or is there some value in these two companies?
I think there's some value in there. I think both have signs of undervaluation, both have room to continue growing. It'll be interesting to see. I mean, what do you think?
Well, both stocks were punished over their last earnings releases. Down over the last week. I say there is value in there. Don't make this, if you were there interested in these two stocks, don't make them a large component of your portfolio. These are kind of more of the story dividend stocks where you can kind of see outwards, again, long-term view that, okay, if they keep doing what they're doing in 3, 5, 10 years, they could be much better than where they are today.
Yeah, and I think this is slightly different than Clorox, who we recently talked about, who dropped over 10% after their last earnings release. Even for them, they were already overpriced compared to the market and to forward earnings. After the 10% drop, they were still in line with the market. You couldn't really say that Clorox was an undervalued stock. These two stocks are different because their PE ratios are so much lower than the broader market.
Right. And again, I will say the outlook was much better. Both companies are expecting a better increase in sales and earnings. So they're expecting things to continue to get better.
So everyone, you heard what we think.
What do you think?
You tell us. Tell us what you think of Kraft. Tell us what you think of Kinder Morgan. We're excited to hear about it. Value traps, stocks to buy, or are you just going to keep watching them? Let us know.
Let us know in the comments. Let us know if you own these two stocks, if you own them before cuts, as well as own them after and have been that long-term investor with that point of view. Share all that in the comments, and if you haven't already, give us a thumbs up and like this video. Subscribe to our channel so you don't miss a beat from the Dividend Diplomats. Now again, this was Bert and Lanny from the Dividend Diplomats. Over and out.